when I first saw it, I thought it was a scam. Oh, you guys are going to just print money out of thin air? That's not going to work. And then I saw it on Reddit when it was somebody sold their house for $1 for it. I was like, all right, that guy probably just lost his house. So then I saw the Wired News article where they were using it on the dark net. And I was like, oh, there's a market. It's working. So I got in, and I got in at the top with everybody else. I helped make the top at $30. And then it went down to $2. That's like a 95% loss. Everyone said it was a scam. I thought it was a scam. But now we find out it's the highest performing asset that's ever existed in the history of mankind. It went from a penny to $69,000, a return of 6.9 million fold, 690 million %. And people are pretending like that didn't happen. That was a long time ago. That Bitcoin has had a price since 2010. It's 2022 now. That's 12 years. So
you're making the analogy essentially that Hex is maybe, it seems like, an earlier form of Bitcoin. That, hey, look, you can still get Hex now, 28 cents or whatever, right?
Yep.
Now, one of the things you mentioned is that with Bitcoin, we don't print money out of thin air because we're mining it, deflationary currency, limited.
Oh, no. It's not. No, none of what you said is true. That's all entirely false. Bitcoin is not deflationary at all. It is inflationary. Miners sell Bitcoin. They harm the price. They buy electricity and mining hardware. So Bitcoin's all about decentralization. But in fact, there's only 5 or 6 mining pools that do all of the mining. And there's only 3 or 4 companies that make all of the mining hardware. And those are the people that make all of the money from the mining, because the economic theory that the cost or resources allocated to extract a resource will trend towards and approach asymptotically the value of the resource. And so as the Bitcoin price ratchets up, the wasting and destroying of the environment with electricity, which you could say Bitcoin's 80% renewable, fine. I used to be a Bitcoin miner. I know exactly how much I paid for my electricity, and I know exactly how much pollution it generated. It wasn't clean energy. So, and then the idea that a decreasing inflation rate is somehow deflation is hilarious. You're getting less inflation over time, but the value dollar cost of that inflation is higher and higher because the price keeps ratcheting up because they keep on-ramping new users. So people now, always, you get this backwards. You described a cost and a negative externality, which is bad for everybody, bad for the environment, bad for the price, but you think that it's actually a benefit. And so you got to know the difference between a feature, a benefit, and a cost. And Bitcoin mining is a cost that's bad for everybody, and you don't need it anymore. There's tons of proof-of-stake networks for years, and they've all been less attacked and more secure than proof-of-work networks.
And that's one of the big arguments that Bitcoin maximalists will have, is that Bitcoin is much more secure. And that is why we have proof of work. Though in the future, once we've mined
less secure,
we expect a transition. What I'm curious, though, for the difference in Hex is that Hex is a proof of stake coin.
Nope.
And we do have a set inflation rate. I believe it's 3.69%. Can you tell me why have any inflation at all then if you're opposed to the mining style inflation in Bitcoin? Because you're essentially saying, hey, the cost of the shovels are going up, so it's becoming more expensive to actually operate the network rather than less expensive, which creates more waste. That's your argument. Why have any inflation then in the Hex coin?
I think we've hit the uncanny valley. So it's like Dunning-Kruger for smart people. Cryptocurrency and trading are two things that have very high skill caps, and then like 130 IQ guys figure that they're good at everything else, so they'll be good at this. But in reality, they're just good enough to be dangerous. So let me clarify some things. First of all, Hex is not proof of stake. It is a hybrid proof of stake, proof of work. We use proof of work on the Ethereum network for transactions, and we use proof of stake just for inflation. Because of that, it's more secure than Bitcoin. Bitcoin's had 2 inflation bugs where anyone could mint as many free coins as they want. One of them was executed on the network in 2010, and they had to roll the chain back because someone minted 184 billion extra free Bitcoin. The same bug, created in a different way, reappeared 2 years ago and was discovered, instead of being exploited, by a Bitcoin Cash developer and responsibly disclosed to the Bitcoin core development team. He could have minted as many free Bitcoin as he wanted as well. And why do we keep getting inflation bugs in Bitcoin? Because it is spaghetti code that is not modular, that has no security audits, that has no written spec, and the wallet code touches the consensus code, touches the networking code. So when you try and improve the network, oopsie, you introduce an inflation bug. It's the most common and vile bug in all of cryptocurrency. XLM has had an inflation bug. Hacker dumped it on the market. Ravencoin had a 10% inflation bug. Hacker dumped it on the market. Bytecoin, Monero, inflation bugs. AVAX, inflation bug. Bitcoin, inflation bugs. You know how you solve inflation bugs? You lock your consensus code in a contract that can never be edited or changed, which is what Hex has done, so that you can improve the network all you want and you don't accidentally introduce an inflation bug. Bitcoin.org was hacked 2 months ago. Hex.com's never been hacked.
The examples. Just a question for you while we're on this. So I know that Hex is built on Ethereum, ERC20, so it's a layer 2 solution. Are you essentially suggesting
really.
that a layer 2 solution is hybrid because it inherits the proof of work of Ethereum? Or could you clarify that maybe for the viewers a little?
You can only mint inflation if you had staked. And so inflation's proof of stake, but you can only also mint that inflation if you submit the transaction to the network, which requires proof of work. Now, all that will matter a lot less because I've already forked to the Ethereum network and it uses proof of stake, and you can go use the test net right now. And you can see all of your coins that you had on the Ethereum network for free, the world's largest airdrop, by changing one setting in your MetaMask. And then your keys, you don't have to sign up, you don't have to do anything. Your keys already work on my network. And the snapshot was from 2 months ago for testnet. It removes all of that energy waste. It removes all of those negative externalities. It has higher throughput, lower fees. It's amazing, right? So I'm telling you how it works now, but in 2 months, that won't even matter as much. See, like it's unmutable. We can't change it. The only thing we can do is give people free coins on another network. And then new users that on-ramp can choose whether to pay $100 to do a Uniswap swap and $20 to send an ERC20, or they could pay a penny on our network. And I think the penny is a better deal.
So to be clear, the proof of work you're talking about is the proof of work of the actual Ethereum transaction,
currently, yes.
Not anything to do. Okay,
exactly. Yes.
So now you've also described it, at least when you go to your website, you've described the Hex coin as a top cryptocurrency certificate of deposit, potentially even the first and maybe even only. Technically, a certificate deposit is a savings account that's FDIC insured. Do you think that some people might be confused by this?
Well, it depends on where you live. So the term certificate of deposit is only popular in the United States. Every other country uses a different term. In Europe and Asia, they're called bonds. In Canada, they're called guaranteed investment certificates. And when you put your coat at a coat check, you get a receipt, which is a certificate of deposit. You deposited your coat at the coat check. And so cryptocurrencies attempt to do useful things online in decentralized, trustless, 100% uptime ways. And we make analogs. So Bitcoin tried to be a peer-to-peer digital currency, failed entirely. And then it tried to be programmable money, failed entirely. However, it did digital gold really well and went up 6.5 million fold in price, which is a bigger market share and a bigger use case. So congrats to all of us. So even though Bitcoin failed entirely to be a currency, people still call it a currency. It's called a cryptocurrency, and it's even taxed as such. And thus, when we try and make something that approximates a certificate of deposit, in reality, there's very little similar at all. Certificates of deposit at your bank have very low volatility. The Hex price has went up 1,000,000% in 623 days and dropped 75% like 6 times. So it's extremely volatile. There's really no similarity other than we monetize the time value of money copying their parameters. So they give you 20% more interest every extra year you lock, and we just copied that parameter and put it on the blockchain.
So a different definition of certificate of deposit. That's what I understand. Now, on this locking, my understanding is for people to earn their currently advertised about 40% yield, they have to stake. And these stakes come with lockup periods, which I believe you need to, maybe you can clarify this, unstake or unlock at a specific time. If you unlock too early, you lose half. If you unlock too late, you lose half. Could you explain this a little bit?
Sure.
What does somebody have to follow exactly to get their 40%? You
don't have to do any of that. The vast majority of your USD ROI comes from the appreciation of the coin. The extra 40% year average, 38% currently, it's just icing on the cake. So instead of making 1,000,000% returns, having bought on January 5th of last year and sold 3 months ago, you could have made 2,000,000% returns, but you'd have an end stake period sometime in the future. So you don't have to end stake at all. You don't have to do any of that. The vast majority of your gains just come from holding the coin.
Because
sure.
Let's call like I'm a real estate guy. In real estate, people tell me appreciation is speculative. I want to know about the cash flow.
Sure.
What do I got to do to get that 40%?
You can lock up between a day and 15 years, which is 5,555 days, roughly. And you choose your term. If you choose shorter terms, then you're going to pay more to gas fees. If you choose longer terms, you get 20% more shares every extra year you lock, up to that 15-year maximum. The issue is, if you, at a bank, withdraw your money early, you're penalized. In this system, if you withdraw your money, you're penalized. Where does your money go? Well, it rewards the people that did what they said they're going to do. I called it the truth engine. And so we have one of the most compelling things in this currency is it monetizes the time value of money. It monetizes delayed gratification, which is the only long-term thing that works in investing or personal development. It has less negative externalities. I think I already mentioned that one. And it has a chart of future market supply. You don't know when Satoshi can dump on your head. You don't know when Mt. Gox can dump their 140,000 Bitcoin on your head. But in Hex, you know when people can dump on your head because they have a chart of releasing end stakes. And then when you create a stake, you can hit your end stake in a notch where no one else is end staking, reducing the volatility because there could be less sale pressure at that point. It's a very innovative feature. Furthermore, I think it's Nobel Prize worthy in that there is no financial instrument I'm aware of in the entire world that has caused people to lock up their funds for 8 years on average. Period. If you get a house, you can sell it. If you get a T-bill, you can sell it. If you get a bond, you can sell it. If you lock up your Hex for 15 years, you can't get out your principal for 7.5. If you remove it before then, you'll get hit in your principal. If you go serve half, you'll just lose your interest, but you'll get principal back. It's very fair. Your penalty is directly proportionate to how much you lied about how long you would stake. And then if you don't end your stake on time, you have a 2-week grace period. Anyone in the world can call the good accounting function to stop you from being penalized if you're hospitalized or if you're in jail, or if you might want to defer income and not have a taxable event. Look, not an accountant, not a lawyer. Get your own financial advice. But if you don't mint your coins, you don't take dominion and control of them, they just are sitting there locked, and you run good accounting, you might be able to avoid a taxable event if you wanted to. But if no one runs good accounting, and you don't end your stake, and it's been 2 weeks, then you start burning at 1% per week until there's nothing left after 100 weeks.
So a couple questions out of this. Mm-hmm. Isn't it possible that you could dump shares like Satoshi?
Yeah, anybody. Look, the reason the Hex price is dumped 75% 6 times is because it's very easy for anyone to nuke the price. And it's also very easy for anyone to cause the price to go up, because what is the trading volume and order book thickness for a Monet painting? Nothing. But their value skyrockets. Why? Because value is supply and demand. So if you want the world's highest performing asset, you must remove liquidity on the ask side, or you'll never get that type of appreciation. The reason that Bitcoin has done so pitifully, by the way, I called the top on the day, and that top call was good for 8.5 months now, and only out of profit one single day by about 6%. Even less than 6%, actually. And I do that for free. I give away that knowledge for free. I did the same thing last cycle. I think it was, yeah. I think that...
Yeah, that's funny. I had a call in January as well, April. That's funny. It was a CPI day.
Coinbase launch. Easy buy the rumor, sell the news event, amongst other things.
There you go. So this is interesting because, see, according to, which I think y'all, and maybe you could speak to this a little bit too, according to CoinMarketCap, you've got a $50 billion market cap, which I think you have a different definition, but Solana has about a $55 billion market cap. The 24-hour volume on your coin Hex is $29 million.
Yep.
The 24-hour volume on Solana is 100 times that at $2.8 billion.
Yep.
Are you suggesting that this lack of daily trading volume is actually good for appreciation?
Oh, yeah. Volume is how you measure how much the users are being victimized. See, you, as a speculator, you don't make money on volume. You lose money on volume. Volume enriches two parties: exchanges that want to see you causing volume to get hit with fees, and market makers that want to see you causing volume to pay bid-ask spreads and fees.
But hold on.
Speculators don't make money on volume at all.
My understanding, and maybe, and this is where I just want you to fill in for the audience, is that if I have higher volume, I have tighter spreads because the order book is larger. If I want to sell a Hex and there's a lack of volume, then how can I actually get hex out? What you're suggesting is,
That's not how that works.
Hey, if you want to take it out, you get punished essentially, so you're incentivized to keep it in. Is that kind of the reverse psychology you're suggesting?
Well, no, people just conflate all these things. So they conflate mistakenly that volume is related to order book thickness. Order book thickness is how good order execution you get. It's how much slippage you have to pay. And so if you go to matcha.xyz or 1inch.io and you say, I want to sell $1 million of hex right now, let's go do that real quick. 1inch.io. Launched
Okay, so
app.
I've never heard of this exchange. What
Oh,
is
sure.
that?
So the majority of liquidity for Ethereum, the largest, thickest order books in the world, are online, on-chain. They're no longer in centralized exchanges, which is beautiful because this means that you can see who's buying, who's selling, what else they own, when they might have stakes ending, what they usually do when their stakes end. It's beautiful and open and transparent, the most transparent trading in the world. When you go on a centralized exchange, you don't know who you're bidding against. You don't know if it's the exchange or in-house market-making team. You don't know whether they're spoofed bids that will get pulled to see who's trying to get order execution. It's trash. Centralized exchanges are garbage. They make you beg for your own money. They get hacked all the time. Billions of dollars have been lost to centralized exchanges. So the majority of hex trading is online, which is, by the way, why the volume number is so low. Because when these other coins list on centralized exchanges, you know what they do? They get fee-free trading accounts. And you know what they do with their fee-free trading accounts? They put tons of bids and asks in between the spread, and they do tons of volume, but the price never actually moves. It's disgusting.
Yeah, I